All right. Lessee accounting for operating leases. So we saw finance lease. We're going to go through the same process for operating leases. Nothing too crazy of differences. Yeah, there'll be some differences, but I'm going to format it the same way. We're going to determine what type of lease it is. Spoiler, it will be an operating lease based on the title here, right? So if a lease does not meet any of the lease classification tests for a finance lease, a lessee should classify it as an operating lease. This is your pure, by definition, lease. This is you leasing a car. For leases classified as operating, the lessee records a right of use asset and lease liability at commencement of the lease, similar to the finance lease approach, and the same amount for lease expense each period over the lease term. Here we are. And again, similar, we are going to read this. I want you to determine, run through your 5 criteria, get a good practice in, eliminate the information you don't need, and then we'll run through what type of lease this is going to be. So assume Bolton Corporation, the lessor, and Sharper Stores, the lessee. So we're from Sharper's perspective at this point. We sign a lease agreement dated January 1st, year 10, and we're using the same dates, which is nice. The lease agreement specifies that Bolton will grant right of use of one of its standard cardboard compactors. It's not specialized in nature, so we know why that's included there, at one of Sharper's locations. Information relevant to lease is as follows. It's a non-cancelable, 3 years. Economic life of 5 years. It has a cost and fair value at commencement of the lease of 60. There's a residual value at the end of the lease of 12. Contains no renewal options. The lift reverts to Bolton at the termination of the lease. So this is important. And implicit rate is 6% and known by Sharper. Now, I don't see an incremental borrowing rate, so that just is not relevant here. We're using 6%. Great. Here's our math, but first let's look at our classification. Okay. Transfer of ownership test, well, at the end, it goes back to the original owner. So that's not relevant. Purchase option test, there's nothing mentioned about a purchase option. The lease term is 60%, so 3/5 of the economic life of the asset, okay, which is less than the major part of the life of the asset, eliminating test 3. Okay, I'll address this one in a second. Alternate use test, well, it's not specialized. It said in the question it's a pretty standardized piece of equipment, so nothing there. Now, for our present value, remember this is 90%. Let's go to our math and just check this one out, right? Let's make sure we're clear on how to do this test. Well, we saw that the value of it is 60,000, right? So it's got to be something divided by 60,000. And here, well, the present value of the residual value, and this is going to have to be given to you, the present value factor, right? It's going to have to be given to you. Residual value at the end of the lease is 12. We are going to take that residual, also known as salvage value, 12. Again, this would have to be given to you. Totally fine. And you are going to multiply these together. That is taking out from the 60,000. Essentially, this is the value that the salvage value has to you today. The salvage value, yes, you will receive 12,000 in cash, but the value that has to you today is 10,000. So 60,000 divided by this 10,000 amount gets you about 49,000. That's the amount to be recovered by the original owner, the lessor, through lease payments. Awesome. We're not done yet. 3 beginning of year lease payments to earn a 6% return. So what we're doing here is this is from the lessor's perspective, right? We are saying that the lessor is basically getting back this amount divided by our present value amount, which would be given, and that gets us 17,620. Now, again, don't stress about these amounts. I just didn't want to give you a whole chart, right? But you would be able to determine these from a chart. You would do a 3-year period at 6%. You would do for this the lump sum. You would do for this at the ordinary annuity, unless it specifies the annuity due. Let's go back to our calculation here. So this 49,000 is the present value of the lease payments, right? We saw this 49,000. That's the present value of the lease payments. This amount to be recovered divided by 60,000. That gets us to 83,020. Sorry, 83,000. That's not 83,000. That is 83.2%. Awesome. So that is not 90%. Therefore, we do not meet the present value, and we're not going to use this. All these criteria are not met, so it is an operating lease. Wonderful there. Again, are they going to drill you for this present value test that hard? Probably not. However, just be aware you might have to do that. A lot of times they'll just say, oh, the present value of the lease payments is going to be 49 and the total value is 60. They're not going to have you calculate the whole thing, but I want you to know how to do it in case they do. Let's take a look at some journal entries. Well, Sharper is the party leasing, right? The lessee. We make the following entry on January 1st, year 10 to record the following operating lease. Right of use asset, lease liability. We saw that before. This is debiting your asset because you put an asset on your books, and you credit your liability because you are also putting a liability on your books. In addition, we record the first payment. I see we're doing annuity due again, so we would reduce our lease liability when we make the first payment and reduce cash for the payment, the same as for our finance lease. Now we're seeing our amortization schedule, our lease liability schedule, right? We are taking our original lease liability of $49,000 and we're allocating it over the 3 years of the lease. Okay, well, we know that it's annuity due, and we know that because of that, the payments are made at the beginning of the period, the beginning of the year. So our first annual payment is on 1/1/10, and that goes straight to principal. There's no interest payment because no time has passed. Now you see, in the next year's time will have passed, so we are going to allocate part of that to interest. But no interest here because we have no time passing. Awesome. Now, what's the journal entry at the end of year 10? So this is a day before this. Keep in mind, right? Keep in mind those dates. This is a day before our 1/1/11. Well, remember, lease expense goes up and up. It's a report of what's happened over that period. So we're going to debit lease expense to increase it by the amount that we have paid. We are going to credit right of use asset. We're not dealing with cash because cash is going to be paid out on the first of every period. We are going to amortize our right of use asset, and then we are going to credit accrued interest because, well, we're going to get rid of this tomorrow on 1/1, but as of right now, we've racked up this interest, but we have not paid it down yet. So this is on our balance sheet. Let's see what happens the next day. Okay, well, on the next day, on January 1st, year 11, what happens? We reduce our lease liability by the principal, right? By the principal. We are going to reduce our accrued interest because we're paying it now. And how do we pay all of this? How do we pay it down? How do we pay down our liabilities? Well, we have to pay it with cash. Perfect. That's the journal entry at the beginning of year 11. Next up, what about at the end of year 11? Well, same journal entry, right? Same journal entry, just the numbers for the next year. Here it is. You just saw it. All right, we're going to increase lease expense because, well, we're pending. We're getting ready for 1/1/12. Getting ready for it. We have our total lease expense, which is the same amount. This is the annual payment. Part of it's interest. Part of it is principal, and same accounting that we just saw. You see the process, get familiar with it, get comfortable with the journal entries. These should make relative sense, right? Maybe you haven't seen right of use asset before this chapter. Maybe, this is the first time you're seeing accrued interest. I'm not sure, but get familiar with it. It shouldn't be too out there. Now, the third and final lease payment is made on January 1st, year 12, as follows. Here it is, right? Here it is, same journal entry. We're paying everything down. We are reducing cash because part of it's interest and part of it is principal. All right. Now we've got the following entry on December 31st, year 12, to record the lease expense for year 12, the third year of the lease. Now this is wrapping it all up. This reduces our right of use asset down, right? Our lease expense now is at our total $52,000. This is getting us to our total numbers. And yeah, this is a good example of good journal entries. Always a good time to practice journal entries. Super important. Get familiar, get comfortable. You'll do just fine.